the Fed, buy gold, and it's possible that they just come out with that sometime, some Sunday night, and that would be great. I mean, that would still be great for gold bugs because you would have to do it at a gold price of $10,000 or more per ounce. In other words, you'd have to devalue the dollar that much to make going back to a gold standard technically possible. So it could be that people with a lot of gold just wake up one morning and find their gold stack revalued by 2 or 3 times. And then we would avoid the horrendous part of the financial crisis that would, under normal leadership, have to happen before they accept a gold standard as the least bad option.
In the dynamic landscape of financial markets, gold continues to capture the attention of investors and analysts alike. A prominent financial analyst and author, JohnRubino, offers a nuanced perspective on gold's potential trajectory, highlighting both optimistic projections and underlying economic complexities. Rubino's forecast suggests a potentially transformative scenario for gold, with 2 intriguing possibilities. He estimates a 10% chance that former President Trump could reintroduce a gold standard, dramatically impacting gold prices and potentially driving them to $10,000 per ounce. This aligns with predictions from some market megabulls, who anticipate gold reaching between $3,000 and $10,000. However, market experts caution against unbridled optimism. While a gold rally seems likely to continue, the sustainability of such extreme price levels remains questionable. Recent analyses suggest that even if gold reaches $10,000, such heights might be momentary, potentially lasting less than a day. The recent dynamics of gold prices reflect complex geopolitical and economic factors. Rubino attributes previous gold price fluctuations to shifting geopolitical tensions, noting that reduced fears surrounding global conflicts and policy uncertainties have impacted gold's risk premium. As a traditional safe haven asset, gold's value remains intrinsically linked to international instability and economic uncertainty. Early 2024 witnessed a remarkable surge in gold demand, driven by unprecedented central bank purchases. Countries like China, India, and Turkey have significantly contributed to this trend. Notably, China extended its gold purchasing streak to 17 consecutive months in March 2024, establishing a new record. Rubino predicts that the Federal Reserve might resort to currency inflation to manage national debt. Such a monetary approach could create a favorable environment for gold and silver investments. However, changing economic conditions, including cooling inflation and a slowing employment market, suggest investors must remain vigilant and adaptable. Before we dive into this video, please subscribe to our channel, hit the bell icon, and share these videos with your friends.
Well, gold and silver were always vulnerable to an equities bear market because the way it has worked the last couple of times is stocks tank, and then that pulls down gold and silver. And then it's kind of a V bottom. The Fed steps in, starts liquefying everything in sight, and then gold and silver just rocket. So that kind of a scenario is possible, if not likely, over the next couple of years. And we have to have that equities bear market first. So that's a thing to worry about with precious metals, but not seriously. Just dollar cost average. Don't try and time these markets because smarter people and smarter computers than us are trying to do the same thing, and it's hard to compete with them. But built into the gold price, which was extremely high, was a lot of anxiety about World War III and dictatorship and open borders, that stuff. So you had the monetary worries that are normal that elevate gold and silver, but you had all this other stuff that people were worried about too. So this election took some of that away. So it's normal to expect that part of the risk premium in gold and silver to evaporate if those risks have evaporated. They haven't evaporated yet, but they've been lessened to the point where it impacts safe haven assets. None of this stuff affects the long-term prognosis for gold and silver. I mean, we've taken on more debt than we can ever manage without some kind of a gigantic crisis. We have to deal with that. And that's going to be a very good time for precious metals because the Fed will conclude that the only way to deal with the debt is to inflate away the currency, and that's a great environment for precious metals. So we'll see that. That's coming. But, and there's one other aspect to this that I might be giving Trump and his people too much credit, but it seems like it's conceivable that they might actually just do something like go back to a gold standard. The Fed, buy gold, and it's possible that they just come out with that sometime, some Sunday night, and that would be great. I mean, that would still be great for gold bugs because you would have to do it at a gold price of $10,000 or more per ounce. In other words, you'd have to devalue the dollar that much to make going back to a gold standard technically possible. So it could be that people with a lot of gold just wake up one morning and find their gold stack revalued by 2 or 3 times. And then we would avoid the horrendous part of the financial crisis that would, under normal leadership, have to happen before they accept a gold standard as the least bad option. So, let's say that's a 10% possibility that the Trump guys just impose a gold standard at some point before there's a gigantic crisis. And, I'm giving them a big compliment by even calling it a 10% possibility, because that's not something people in current power think of as conceivable, let alone desirable, and if those guys thought that would be awesome. But in any event, gold and silver will do just fine in what's coming.
JohnRubino has highlighted a significant deviation from standard economic predictions. Despite the Federal Reserve's anticipated interest rate cuts, bond yields, particularly for the 10-year Treasury, have unexpectedly risen, effectively tightening monetary policy instead of loosening it. In a striking development, the 10-year Treasury yield reached 4.488% this week, marking its highest level since July 1st. Market expectations for a December rate cut have dramatically diminished following comments from Fed Chairman Jerome Powell. This persistent pressure on bond yields stems primarily from ongoing concerns about the federal deficit, creating a market environment that defies historical patterns and conventional economic thinking. Rubino's analysis highlights the long-term risks of quantitative easing. It aligns with fiscal theory, which posits that inflation can remain stable under specific interest rate targeting mechanisms, such as a fixed peg or a consistent percentage rule. The relationship between interest rates and inflation proves more nuanced than typically perceived. While higher interest rates can temporarily suppress inflation, they may paradoxically contribute to higher inflation in the long term. Let's get back to the video.
Boomers are retiring, so we have trillions of extra dollars that have to go to my generation. We have $35 trillion and rising of debt already borrowed by the federal government. So the interest cost on that debt is spiraling out of control now. It's parabolic and continuing to go straight up. And stuff like that can't be fixed if you don't just take a meat axe to government spending. And, we're not going to do that. We're not going to cut Medicare. That's politically impossible. Social Security, politically impossible. The defense budget, I wouldn't call that politically impossible, but the guys in charge that even Trump is putting in charge right now are never going to stand for a 1/3 cut in the military budget, which we should do, but we won't. So the big items in the government budget, which are interest, Medicare, Social Security, and the military, are untouchable. I mean, they could be made more efficient, but generally speaking, spending on them has to go up. So there's no fix, and the market kind of has to impose something on us at some point. And that's already starting to happen. That the Fed started a new easing cycle here. They cut interest rates by 50 basis points, then another 25 basis points. And you would expect if the Fed can control interest rates, that long-term interest rates would start going down once the Fed starts cutting short-term interest rates. Bond yields, especially the 10-year Treasury, which everything keys off of, bottomed just before the Fed started cutting and has been going up ever since. So in effect, monetary policy is tightening no matter what the Fed is talking about now. And until they go back to QE and they start buying long-term bonds with newly created currency. But can they really do that? Because we found out what happens when you flood the system with new currency in 2021, 22. We ended up with double-digit inflation in 2022. And people know that's possible now. It's in short-term living memory for most of the country. So if the government tries that again, in other words, tries aggressively to push down interest rates by creating a lot of new dollars and dumping them into the banking system, we're liable to see everybody front run that this time. In other words, they see the conditions are being created for another bout of inflation, so everybody panic buys everything, which sounds suspiciously like the Austrian economics crack-up boom. So we'll see. We don't know for sure that that's the way it's going to play out, but there doesn't seem to be another scenario in which the Fed aggressively tries to get a grip on interest rates. And if they don't do that, then interest rates are going to stay high enough to bankrupt all kinds of entities out there, commercial real estate, housing, because house prices are unaffordable for the average person. So hardly anybody can buy a house now. And you need either falling house prices or falling mortgage rates. Well, if we don't get falling mortgage rates because bond yields are going up and that's pulling mortgage rates upward, then nobody's going to buy houses. And we're seeing a lot of new inventory come onto the market right now. So if that inventory has to sell, which a lot of it will have to sell, that means house prices have to tank. So there's one recessionary indicator right there, Housing is frozen, house prices are going to tank. And you can look around at other parts of the economy and find similar stories where an awful lot of things are pointing towards a recession unless interest rates plunge from here. And the only way to make them plunge is to risk another bout of serious inflation and all the knock-on effects that implies. So we're kind of in that box, Dunnigan, where the Fed has no way out and they can only choose one crisis or another. There's no organically growing, healthy economy that can flow from where we are now. There has to be some kind of a crisis.
Gold and silver remain critical assets to watch in times of economic uncertainty. While short-term fluctuations may occur due to shifting geopolitical risks and changing monetary policies, the long-term outlook for these precious metals remains strong. As inflationary pressures persist and debt levels rise, both gold and silver stand to benefit, particularly in environments where currency devaluation or fiscal instability threatens traditional assets. What do you think about the future of gold and silver in light of current economic trends? Share your thoughts in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more updates. Thanks for tuning in.